In last 1 year, Redington has generated a revenue of 74,830 crore. Now, can you guess its valuation? How much would you value it? Even if you take a price to sales ratio of 1, market cap should be around 74,000 crore, isn't it? But this company is available at a market cap of just 13,000 crore. Difficult to digest, isn't it? How can a company with a revenue of 74,830 crore, that too in just 1 year, commands a market cap of just 13,000 crore? In fact, in last 1 year, this company has generated a profit of 1,467 crore. Yet it commands a market cap of 13,000 crore that translates to a price to sales ratio of 9.2. Looks grossly undervalued, isn't it? Hello everyone, my name is Sahil and this is my Personal Finance Academy. In today's video, we are going to discuss the business model of Redington India that commands a price to sales ratio of just 0.18 and price to earning ratio of just 9.2. And we'll try to understand why the valuations are so dirt cheap. It is a classic case study on valuation analysis. And of course, we'll figure out if it is a great opportunity to add Redington India in the portfolio or not. But before that, let me repeat, this is not a stock tip. The idea is to help you understand the business and growth prospect along with key opportunities and challenges so that you can take an informed investment decision. By the way, I recently did 2 videos on valuation analysis where I explained how to identify if a stock is overvalued or undervalued. If you are a long-term fundamental investor, I'm sure you'll find the video useful. Alright, let's get started with today's video. Established in 1993, Redington is a leading distributor of IT and mobility products and a provider of supply chain management solutions and support services in India, Middle East, Turkey, and Africa. So basically, Redington procures IT and mobility products from vendors, handles its distribution, logistics, and sells those products to resellers and dealers. So it is a distributor of IT and mobility products like your laptops, mobile phones, etc. Remember, it is a distributor of IT products, not the manufacturer. Now, if you look at the product portfolio of the company, it can be divided into 2 categories. First is pure distribution, where it distributes your IT and tech products like your PCs, laptops, MacBooks, then your iPad, printer, smartphones, including your iPhone, then networking devices, etc. In fact, company has also forayed into the business of distribution of solar green energy products. Then there is second business, which is services and solution, where company provides the distribution of cloud services, logistics, business process management, BPO, 3D printing, etc. So basically, Redington helps global brands all over the world in distribution of their products and services and help technology reach market at faster rate. And since technology is one sector that quickly evolves over time, brands need to ensure that the tech products and services reaches the end consumer as early as possible. Redington deals with over 290 global brands of the world. Some of its top vendors include Apple, that is the biggest vendor of the company and contributed 29% in company's H1 of FY23 revenue. Then its other top clients with highest contribution in revenue include your HP, followed with Dell, Lenovo, Samsung, etc. Some of the other well-established brands that are partner of Redington include Acer, AWS, Asus, Broadcom, Canon, IBM, Google Pixel, then MI, Salesforce, then your Oracle, VMware, Google Cloud, etc. Redington has a very strong distribution network with 43,000 plus channel partners, including your sub-distributors, retailers, resellers, e-com players, system integrators, etc. Then it is across your India, Middle East, Turkey, and Africa. So Redington basically caters to the emerging market. Now, if it just summarize, Redington is into the business of distribution of A, IT and tech products like your PCs, laptops, smartphones, solar products, then B, services and solutions like your cloud, BPO, etc. And now there is third segment that company also caters to, which is logistics. Since Redington is a distributor of IT hardware, it requires huge warehouses to store the products. Now what Redington has done is it has not just limited its warehouse services to its own business. It also provides warehouse services to other distributors and service providers. In fact, currently 85% of warehouse business revenue comes from outside of their business. Currently, Redington has 3 automated distribution centers in Chennai, Kolkata, and Dubai. Now, if you look at the revenue contribution by geography, in FY22, 43.5% revenue contribution was from India, 11.8% from Turkey and South Asia, and 44.7% from Middle East Africa. By the way, Redington is at either number 1 or number 2 position in the markets they operate. So they have a leadership in distribution business in emerging market. Interestingly, Redington does not have any promoter. They exited completely before 2017. So Redington is a professionally run institute. This might be a little uncommon for Indian companies, but it is very common in US. Although there are some good professionally run institutes in India as well. Even ICICI Bank does not have any individual promoter. So does your ITC. There are no promoters of ITC. Likewise, there is no promoter of L&T as well. So ideally, you want to invest in a company that has a strong promoter base, but it is not a fixed rule. There can be good professionally run companies, and Redington is one professionally run company. Now, if you look at its leadership, Mr. Rajiv Srivatsava is the MD of the company, and he has over 30 plus years of experience in various leadership roles. Before joining Redington, he was the MD and CEO of IEX, and before that, he was the MD of HP India. He has done his graduation from BITS Pilani and diploma in international business from Helsinki School of Economics. Then Professor J. Ramachandran is the chairman and independent director of the company. He is a professor of strategy at IIM Bangalore. His research has been published in leading international journals, including Harvard Business Review. So as a chairman, he oversees Redington journey. Then another independent director of company is V.S. Hariharan, who is a graduate from IIT Madras and MBA from IIM Bangalore. Overall, Redington has a very experienced leadership and board of directors. As far as future is concerned, it is a no-brainer that future is all about digital. Just think about it. Are you going to stop using those computers and laptops and smartphones? In fact, the usage of computers and smartphones is only going to increase over time. There are still millions of people in India and other emerging markets like Africa who do not have access to laptop or smartphone. And even those who have access to these devices would keep on upgrading them. For example, iPhone market in India in FY21 was just 2.2%. This market has more than doubled in FY22 at 5.5%. Yet it is still just 5.5%. So imagine the potential in premium smartphone category like iPhone in India, and I'm sure this will only grow over time as more and more people are able to afford such premium phones. And it's not just about smartphones. There's a growing craze for wearable devices like your smartwatches, wireless earbuds, etc. And the demand for these wearable devices has just started. So the point is that the sale of IT products is only going to increase over time. And it's not just about IT hardware, but look at the service side. I'm not sure how many of you are aware of this, but having an IT background myself, I'm confident that ultimately in the future, everyone would shift to cloud services. In case you don't have IT background, cloud service means you won't need a storage device to store your data. Just to give you an example, earlier we used to save our data on laptops, phones, pen drives, hard disks, but today we can simply store the data over Google Drive or iCloud. That's essentially a cloud service. Likewise, if you remember, earlier we would have to install heavy softwares like Microsoft Office, etc. on our computer. But today, we can access entire Microsoft Office online using Office 365, that is essentially a cloud-based service. You just need an internet, no need to install any software. In fact, every major company today has either shifted to cloud service or is in the process to shift to cloud because these big corporate houses have terabytes and terabytes of data, and if they want to store the entire data on their own premise, they would need to spend millions of dollars on buying servers and its maintenance. However, today they can use Amazon AWS or Microsoft Azure to simply store the entire data over Amazon and Microsoft Cloud and just access it using internet. It saves huge amount of money for corporates. So cloud is one big trend all over the world. And companies like Redington help Amazon AWS or Google Cloud increase their reach in tier 2, tier 3 cities using its strong distribution network. Likewise, there are many other trends like your 5G services, cyber security, digital payments, etc. that would create great opportunity for Redington in the future. As far as financials are concerned, company's revenue have grown consistently from 16,000 crore current levels of 74,800 crore. Profits have grown from 265 crore to 1,467 crore in trailing 12 months. Again, it has been a consistent growth at CAGR of 16%. If you look at the profitability, both ROE and ROC are on higher side with latest ROE and ROC both about 20%. Company has a debt to equity of 0.3, which is also under control. So growth has been good, profitability has been good, debt is also under control, and the future is also digital. Then why does company command such a low P ratio of 9.2 and price to sale of 0.18? I tried to dig deep into this and I got my answer. The biggest reason for market giving a low premium to Redington is its business model. Now think about this. On one side, you have IT product manufacturer and service providers like your Apple, Amazon, Google, HP, Dell, etc. And on another side, you have retailers who sell the IT products and services to end consumer. The end consumer can be retail people like you and me as well as organization. It could be small company, mid-size or even large company. Here the role of Redington is like a middleman that facilitates the distribution and make money in between. And they operate on a very low margin in the range of 2 to 3%. That is the reason, in spite of generating revenue of 75,000 crore, company's net profit is only 1,460 crore. Now what if you remove this middleman and companies directly sell the products and services to retailers and end consumer? It could be possible, right? That's the biggest concern people have with Redington business. If big companies decide to sell directly, then Redington could lose its business. So there's a potential threat to Redington business, as these days more and more companies prefer to sell directly to end consumer. Hence, market doesn't like to give a high premium to Redington. For instance, Apple, that is the largest vendor of Redington and contributes significantly in its business, has recently started its own retail store in Mumbai and planning to open more stores in near future. That's a big risk to Redington business. However, the silver lining is that no business operates on a single model. Companies use multiple business models and channels to sell products and services. So on one side, while Apple or Amazon does have big clients whom they supply the products and services directly, they also need distributors like Redington that can help increase their customer base, especially in tier 2 and tier 3 cities and small clients, as Amazon and Google can't focus on small clients. And that's where I think that Redington is adding huge value. Apart from this, there are two more risks: receivable risk and inventory risk. Let me help you understand this. So receivable risk here means that Redington as a distributor gives products and services on credit to retailers, and this credit is for 15, 30 to 60 days. At any point, Redington has an outstanding amount of 10,000 crore rupees in the market. So there is always a risk of receiving back the money, as some retailers might default on payment. Although the company has set up a robust process over the years to ensure timely recovery. Then second risk is inventory risk. Here you need to understand that IT hardware is a category where prices only go southward. It means if the inventory like a smartphone or laptop is sitting for 6 months in the warehouse, its prices might fall 30-40%. There is no other industry that has such levels of crazy obsolescence. So if Redington is sitting on high inventory, it is like sitting on a time bomb. Hence, company need to ensure a quick churn of inventory turnover, as there is already a very thin margin on which the company operates. So these are some big risks, and considering all the pros and cons, market is valuing Redington at very low level. I hope now you got a clear picture of the business model of Redington. This is a great case study, as many people simply look at P ratio and decide the valuation. So there is no guarantee that a low PE always means company is cheap, and there is also no guarantee that a high PE also means company is always expensive. It all depends upon the future growth prospect, key challenges, competition, etc. By the way, it really takes a lot of time and effort to do such analysis. I hope you'll appreciate my efforts. Overall, I believe that Redington is a fundamentally strong company. The future of their business is also bright. Yes, there is a big threat with vendors like Apple directly selling to retailers via D2C model and other key risks like your inventory and receivable. But Redington has a vast experience of managing the distribution for many decades, and company is growing constantly and a consistent mode in last 15 years. So at current levels, Redington is trading at a levels of 170 rupee with a P ratio of 9.2 and a price to sale of 0.18. Considering all pros and cons, it is debatable whether the valuations are cheap or not. Personally, I find the valuations attractive. Like I said before, the distribution business will not vanish overnight. It will coexist with other models. And considering the huge network, Redington will continue to add value and grow on a consistent basis. That also does not mean that Redington will jump 2 to 3 times from current levels in the near term to command a P ratio of 2025, because historically this company has commanded a median PE of 9 in last 5 years. But since company's earnings are growing on a consistent basis, Redington should generate a decent return of 15% on a CAGR basis which is a very good return. Considering that, Redington share price should also do well and generate a good return for its investor. Interestingly, company also provide a very good dividend. Currently, its dividend yield is nearly 4%. As far as Redington shareholding pattern is concerned, since there are no promoter, Redington stakes are with FIs and DIs and public. Within that, 60% stakes are with FIs that shows strong confidence of FI in Redington. It includes top FIs like Fidelity Group and even MIT holds stake in the company. Then DI's stake in the company has been consistent in last many quarters at around 16%. So nearly 76% stake of Redington is with institutional investors. That shows that Redington is fundamentally strong company. Now tell me, what do you think about Redington Business? Is it worth investing the money in company or not? I hope you'll find this analysis useful. I'll see you in the next video. Till then, take care.